What is a repo transaction and what is a reverse repo transaction? Hello everybody, I'm your learning partner Sushila Hariharan, and I love to ask this question at many interviews because participants get very confused at this question. They want to know what is the answer. So let's understand this better. If you're interested in a career in investment banking, hedge fund accounting, OTC derivatives, and trade life cycle, do subscribe to my YouTube channel where we provide content centric, research focused videos on these topics. So, one of the many commonly available types of trades in money markets are repo trades. Repo stands for repurchase order. Okay, so in money markets, as we already know, the transactions are for a short duration. It is a short term debt market wherein the maturity of the instrument is less than 1 year. So we have treasury bills which are issued by the government in various maturities ranging from 7-day treasury bills in the US right up to 270-day treasury bills. Different countries have different maturities for their treasury bills, but suffice to say that treasury bills represents those instruments that are issued by the government. We then have commercial paper which is issued by corporates and certificates of deposits which are extensively traded in the money market. So as we understand, money markets is the short duration market. So what is a repo trade? A repo trade is a collateralized short term borrowing. But you just said the full form of repo is repurchase order. Then now you're saying it is a collateralized short-term borrowing. Exactly, my friends. Repo is nothing but a lending and borrowing mechanism. Then how is it a short-term instrument? Because most of the time such trades take place for durations as short as 5 days and sometimes can extend all the way up to 14 days or even 15 days. Okay. So a repo trade is nothing but a sell today with a commitment to buy back at a future date. Alright, so let's say today, 1st of April, my favorite day, given that it's April Fool's Day, is the day on which two investment banks or two banks get into a trade. Let's call them as Bank A and Bank B for imaginative purposes. Bank A enters into a short term repo trade with Bank B. This means Bank A is selling the securities and it's a commitment to buy back the securities after 5 working days from Bank B. So the securities are given from Bank A to Bank B. In return, Bank B gives money to Bank A. So this is like a loan arrangement. Is it collateralized or unsecured? Is it collateralized or non-collateralized? Obviously it's collateralized because Bank B has given money to Bank A on the basis of the value of the securities that Bank A has given Bank B. Okay, so therefore it's collateralized. Is it short term? Yes, it's short term. It's for a period of 5 days. So what happens is, while the funds get transferred from Bank B to Bank A, the money movement that takes place is like a loan. Okay, Bank A then enjoys the funds for 5 working days, and on the 5th working day, Bank A returns back the principal amount plus interest to Bank B. Okay, so Bank B, which has lent money, will earn interest for that many number of days for the loan that it has given to Bank A. So Bank B earns interest. So on 5th working day, Bank A returns back the principal with interest. Bank B gets back the interest with along with the principal, and therefore what happens to the securities? What happens to the collateral? The collateral is returned back by Bank B to Bank A because the loan is now over. So from the point of view of Bank A, they have borrowed money, or have they lent money? They have borrowed money. So therefore it is a repo trade for Bank A. What about Bank B? Have they lent money or have they borrowed money? They are the counterparty to the trade, therefore they have lent money, and for bank A it is a reverse repo. So we have to understand the only difference between repo trade and reverse repo trade is from whose perspective you're seeing. If you're seeing from the perspective of the borrower, it is a repo trade because it is a sell and a buyback. So repurchase. And whereas for the lender, it is the reverse repo because we are lending money to the counterparty. Okay, so reverse repo is a buy and a sell back. No, that doesn't make sense. So therefore we just say from the lender's perspective we call it as a reverse repo, whereas from the borrower's perspective we call it as a repo trade. So now we are clear, and we should not make this mistake at the next investment banking interview we go, because clearly repo trades are from the perspective of the borrower and reverse repo trades are from the perspective of the lender. All the very best.